So next topic, mutual funds. So welcome to CA panel revision series, AFM revision series. So we have completed time value for money, advanced capital budgeting, portfolio management, derivative analysis and valuation. Now we are going to discuss mutual funds. Okay, in portfolio management we have learned how to find out the return and risk of a security, how to find out the return and risk of a portfolio. So we learned how to analyze the security, analyze the portfolio, right? So now the concept is mutual funds. What is this concept? Mutual funds. So generally to invest in stock market, we need money, next time, and also knowledge. Yes or no? Money, time, and knowledge. Okay. So for example, here I am taking the names CA, Naveen, Pranav. Okay. CA Naveen, Pranav, and CA Balaji, CA Pawan Kalyan, and CA Navaneet, and uneducated Manoj. Uneducated Manoj, example. So first five, they are all chartered accountants. They have a knowledge how to analyze the security, how to analyze the portfolio, right? But they do not have a time because they are engaged in practice. They are busy in practice. So they do not have a time to analyze the security and portfolio. Lorry చూస్తామా కిటికీ ఓపెన్ చేసి హార్న్ వినపడంగానే వెనక్కి తిరిగి ఎత్తుకుంటున్నాంటి. Okay. So first five people, so they are chartered accountants. They have a knowledge to analyze the security. They have a money to invest in stock market. But the main problem is what? They are into practice. They do not have a time to analyze the security or a portfolio. Okay. And next, Manoj. Manoj, he is having a money. He has a time to analyze the security and portfolio, but he do not have a knowledge how to analyze the security and portfolio. Okay. So now all these people who have a money, who has an interest to invest in stock market, but do not have a time to analyze the security or do not have a knowledge to analyze the security, so they will be investing money in mutual funds. So mutual fund is a professionally managed fund. Professionally managed fund. Example, mutual fund is managed by what? A qualified CA or a CMA or CFA, Chartered Financial Analyst. Okay. So in our example, this mutual fund is managed by CA, CMA, CFA, Charan. Okay. So this person is having a knowledge and time to analyze the security. His full-time job is to analyze the security and analyze the portfolio and to invest money in stock market on behalf of investors. On behalf of investors. Mutual fund is a trust. Mutual fund is a trust. So the only job of mutual fund is to make investment in stock market on behalf of the investors. Okay, clear? So what is this A, B, C, D, E, F? These are the securities. So CA, CMA, CFA, Charan, he analyzed the security and he identified, he selected how many securities? 6 securities. He selected 6 securities to make investment. So 6 securities are selected and here investment is made in 6 securities. Okay, clear? So this is how the mutual fund concept works. So mutual fund is a trust. Mutual fund is a trust. So now what is the benefit CA Charan is going to get? What is the benefit? The benefit he is going to get is, first of all, he will be taking a fixed percentage on a portfolio value. Fixed percentage on a portfolio value. For example, the portfolio value is equal to 100 crores. The amount invested by investors is equal to 100 crores. On that 100 crores, he will be taking a fixed percentage. Let us say, for example, 0.1%. 0.1%. Okay. And apart from this fixed percentage, he will be taking an incentive if the fund performs well. If the fund performs well, he will be taking a incentive, bonus. Okay. Clear? Nothing but if there is a capital appreciation, if a benefit is derived by the investors, then he will be taking a bonus, incentive. Okay. So this is how the mutual funds are managed. So you know the SBI mutual funds for every bank. So there is a concept of what mutual funds, right? So mutual fund is simple. It is a fund, okay, which is managed by a professional. Which is managed by professional. Now in this chapter, this chapter, you will not be finding many formulas like we found in portfolio management. In this chapter we need a basic formula, that is P1 minus P naught plus D1 divided by P naught. Okay, so first here investors will get a return in the form of ultimately again capital appreciation and dividend, or interest, because the fund which is invested in mutual funds may invest this money in either equity or a debt. If it is invested in equity, mutual funds will receive a dividend. If it is invested in debt, mutual funds will receive interest, and this dividend or interest income received by the mutual funds will be passed on to the investors. And likewise, mutual funds may purchase the security, invest the money in A, and may sell the investment in A for a profit or a loss. Okay, so that means mutual funds may get a capital gain or a capital loss. If it gets a capital gain, that capital gain will be passed on to what? Investors. Okay, so if you are investing money in company, you will get shares. Yes or no? Shares are issued by the company. If you are investing money in mutual funds, you will get units. Units are issued by the mutual funds. Instead of shares, we call here units. Okay, we have a concept of face value in company. Likewise, here also we have a concept of face value. Face value can be 1 rupee or a 10 rupees. Okay, now, and these funds can be open-ended fund or a closed-ended fund. Open-ended fund means what? Investors can join anytime and can exit at any time. For example, so we have 6 investors in this example. In these 6 investors, next day, Naveen may go out and Yogita may come in. Okay, and Yogita may go out and Tejas may come in. So this is a concept of what? Open-ended fund. Open-ended fund means what? Investors may come and go at any time. Close-ended fund means what? For a specific period of time. Investors cannot come in and cannot go out. For example, it is a close-ended fund for 2 years. That means for 2 years, investors cannot come in and investors cannot go out. Are you getting my point? So fund can be an open-ended fund or a close-ended fund. So here, so we have a concept of NAV. First, you should know what is this NAV. NAV. You know the concept of net worth, right? Net worth is equal to total assets minus outside liabilities. Total assets minus what? Outside liabilities. Sir, what is this NAV, net worth? Before understanding what is this net worth, imagine the balance sheet of a mutual fund. How the balance sheet of a mutual fund looks. Simple. In balance sheet of a mutual fund, you will not find plant and machinery. You will not find land and building. You will not find any fixed assets. Yes or no? Why? What is the purpose of mutual fund? Purpose of mutual fund is to collect the money from the investors and invest this money in various securities. So that's why if you see the balance sheet of a mutual fund, you will not be finding any plant and machinery, or a PPE or a intangible asset or anything else. So what are the assets you are going to find in balance sheet of a mutual fund? What are the assets you are going to find in the balance sheet of a mutual fund? In the balance sheet of a mutual fund, if you take the simple balance sheet of a mutual fund, here you should understand the basic. Okay, if you see the balance sheet of a mutual fund, on right hand side, asset side, you will find what? Investment in A Limited, B Limited, C Limited, D, E, F. Nothing but on the balance sheet, on the asset side of a balance sheet, you will find shares and debentures. Yes or no? Yes or no? For the mutual fund, what is the asset? Only the investment made in various securities. Apart from this investment in various securities, what other kind of assets you can find? You may find cash. You may find what? Cash. Okay. And receivable. What is the receivable? For example, dividend is declared by this A company or a B company, but not yet paid, because dividend need not be paid immediately. What is the due date for payment of dividend? Within 30 days of declaration. Yes or no? So dividend has to be paid within 30 days of declaration. So you can check with law, provisions. So the point is here receivable. There can be receivable. What is this receivable? What is this receivable? Simple. A company has declared a dividend but not yet received by the mutual funds. So that is also an asset. That is also an asset. Okay. So if you see the balance sheet of a mutual funds, you will be finding what? Investment in various securities, cash and receivable. Apart from this, you will not be finding any other asset. So the balance sheet of mutual funds looks simple. You will not find any plant and machinery depreciation, land and building depreciation, etc. Why? Because the mutual fund purpose is to invest money on behalf of the investors. What about the liability side? On liability side, you will not find any debentures, you will not find any bank loan, you will not find any kind of long-term loans. Because why do the mutual funds take a loan? Mutual fund will not be taking a loan. Mutual fund is just a trust. It will invest on behalf of the investors. Yes or no? So that's why if you see the balance sheet of a mutual fund, you might find only the arrears. Only the arrears or outstanding expenses. Arrears or outstanding expenses. Arrears or outstanding expenses. So what are these arrears or outstanding expenses? Simple. For fund manager, we have to pay 8 lakhs. For fund manager, we have to pay 8 lakhs. But on 31st March, by the end of 31st March, we paid 7.2 lakhs and 0.8 has not yet paid. Okay, so what about this 0.8? 0.8 is liability or an asset? 0.8 is a liability. So that we may be paying in the month of April. But if you prepare a balance sheet for the year ending, if you prepare a balance sheet as on 31st March, then that 0.8 will be appearing on the liability side. Okay, and what about the balancing figure? This balancing figure is nothing but what? Capital. Okay, so nothing but this we called as a net worth. In case of a company, we call it as a equity. In case of a company, we call it as a equity. Equity is equal to equity share capital plus reserves and surplus. Equity share capital plus reserves and surplus. How do we get that net worth? Total assets minus outside liabilities. Okay, here instead of calling it as a net worth or equity, we call it as a net asset value. Net asset value. Okay, so this net asset value changes on a daily basis. Why this net asset value changes on a daily basis? If you take the balance sheet of a manufacturing company, the plant and machinery value will not change on a daily basis. Land and building value will not change on a daily basis. Yes or no? We are not going to do a valuation on a daily basis. Okay, but whereas if you see the balance sheet of a mutual fund, what happens is, if you are making investment in listed company share, the share price changes every minute or for every half an hour or 1 hour, the share price keeps on changing. Yes or no? So that means what happens? Your investment value, your investment in various securities, the value keeps on changing. Okay, so that means the right hand side asset value keeps on what? Changing. Okay, see, for the investment in various securities value is changing, then automatically what happens? This NAV, net asset value, will also change. Simple. I invested money in security A. If the share price of A increases, if share price of A increases, then what happens? The asset side total will increase. Asset side total increase means what? Nothing but my net asset value increases. Net asset value increases. So how do I get net asset value? Total assets minus outside liabilities. Total assets minus outside liabilities. So the first important term here we are going to learn is NAV, net asset value. How do we get net asset value? Total assets minus outside liabilities. So why are we learning this NAV? Why it is important? Because in case of a mutual funds, NAV is going to change on daily basis. NAV is going to change on daily basis. Okay, clear? Simple. Let me take a small example. For suppose the capital is 100 lakhs. So entire 100 lakhs is invested in A. Entire 100 lakhs is invested in A. Only imagine that only we invested money in A. So the face value is 10. What is the face value? 10. Face value 10 means number of units is equal to what? 10 lakhs. 100 lakhs divided by face value 10. So that means 10 lakhs is the number of units. Next day, what can happen next day? Next day the share price may increase. Share price of A may increase. Let us assume the share price of A increased by 10%. increased by 10%. Then what about this investment value? This investment value increases to 110 lakhs, increases to 110. Imagine there is no cash, there are no outside liabilities. So that means this net worth increases to what? 110. Net worth increases to 110. So 110 divided by number of units 10 lakhs. Your NAV is equal to 11 rupees per unit. NAV per unit is equal to 11 rupees. Next day again share price may increase to 130. Okay, so then what? NAV per unit is equal to 13 rupees. NAV is equal to 13 rupees. Are you getting my point? So simple concept. Net asset value. First you should understand the term net asset value. How do we get net asset value? Total assets minus outside liabilities. Sir, how can we get a cash? Simple. So what is this cash? I have collected 100 lakhs from the investors. Okay, it is not mandatory to invest 100 lakhs at a time. Okay, I will wait for the good opportunity, right? For example, 98 lakhs invested. That means cash balance is 2 lakhs. So why I'm keeping cash 2 lakhs? I might be waiting for what good opportunity. So that's why mutual funds may have a cash also. Or else what? Dividend is received by the company. Dividend is received by the mutual funds. Okay. So immediately I will not be paying to the investors. I may take 1 day or 2 days time. So that's why what mutual funds may have a cash also. Okay. So simple this chapter. In this chapter you should know the basic formula. NAV per unit is equal to total assets minus total liabilities divided by number of units outstanding. So here we have a concept of holding period return. Sir, what is this holding period return? NAV1 minus NAV naught plus income divided by NAV naught. This formula looks similar to what? P1 minus P naught plus dividend divided by P naught. Okay, here holding period return is calculated from the perspective of the investors. Holding period return is calculated from the perspective of investors. How do we calculate holding period return? NAV1. NAV1 means what? Net asset value at the end minus NAV naught, net asset value at the beginning, plus income. What is this income? So dividend and interest may be received by mutual funds from company A, B, C, D, F. And this dividend and interest income will be passed on to the investors. Yes or no? Apart from increase in net asset value, so what is the other benefit investors may receive? Investors may receive the interest and dividend income from the mutual fund. Are you getting my point? So that's why what is the holding period return formula? NAV1 minus NAV naught plus income divided by NAV naught. So in previous example, I told you that NAV increased to 13. Initially NAV was 10 rupees, but later on it increased to 13. So 13 minus 10 plus income 0. Okay, I didn't talk about income. So that's why 13 minus 10 plus income 0 divided by what? 13. Sorry, 10. So the answer is 30%. 3 divided by 10, 30%. Okay, so holding period return within a day. So I told you in 2 days, share price increased by 30%. Yes or no? So in my example, the holding period is 2 days. Holding period is 2 days. In 2 days, the investor is getting 30% rate of a return. 30% rate of a return. Are you getting my point? Okay. So how do I calculate holding period return? Simple NAV1 minus NAV naught plus income divided by NAV naught. How do I get NAV? NAV is equal to total assets minus outside liabilities divided by number of units. Number of units outstanding. So whenever I say NAV means generally they expect you to calculate NAV per unit. NAV per unit. Clear? So next, so holding period return is equal to NAV1 minus NAV naught plus income plus gain. Gain means nothing but capital gain. The capital gain received by mutual funds will be passed on to what? What is this capital gain? For suppose we purchased the securities for 60 lakhs, sold for 63. What is the capital gain? 3 lakhs is the capital gain to the mutual fund, and this capital gain will be passed on to the investors. Okay. So the return to the investors is equal to capital appreciation NAV1 minus NAV0 plus income. You just remember income. Income can be interest, dividend or a capital gain. Interest, dividend or a capital gain. Clear? So to convert this holding period return into annualized return, annualized rate of a return. How can I find out the annualized rate of a return? Annualized rate of a return is equal to holding period return into 12 divided by number of months. Nothing but in 2 months we got 30% or 2 days we got 30%. Now I should convert this holding period return into annualized return. Okay, instead of, so this 30% is a return for how many months? 2 months. Now I should convert this to 12 months. For 12 months means what is the calculation? 12 divided by 2 into 30. 12 divided by 2 into 30. Nothing but 12 divided by holding period into holding period return. 12 divided by holding period into holding period return. Yes or no? Are you getting my point? Okay. If holding period is given in days, holding period is given in days, then holding period return into 365 divided by number of days. Number of days. So these are the basic formulas you require to solve the mutual funds questions. Mainly these three. Only three. One is NAV per unit. How do we get NAV per unit? NAV per unit is equal to total assets minus outside liabilities divided by number of units outstanding. Next, holding period return. Holding period return is equal to NAV1 minus NAV0 plus income divided by NAV0. Okay. Next, converting holding period return into annualized rate of a return. How do I get annual return? Holding period return into 12 divided by holding period or 365 divided by holding period. So these are the main formulas. So the other miscellaneous formulas are R2 calculation. What is this R2? R2 is equal to R1 divided by 1 minus initial expenses plus recurring expenses. Recurring expenses. R2 is equal to R1 divided by 1 minus initial expenses plus recurring expenses. Okay. So what is this R1? R1 means the return which can be earned by the person if he invests on his own. If he invests on his own personal earnings. Example, Manoj, he can earn 16% rate of a return by investing on his own without any professional support. By investing on his own, he can earn 16%. He can earn 16%. Okay. But he is thinking of investing this money in mutual funds. Okay. By investing on his own, he can earn 16. But instead of investing on his own, he wanted to invest in mutual funds. But if he is investing money in mutual funds, so you know the mutual funds too, it has to collect the money from investors. It has to give advertisement. It has to give advertisement. It has to collect money from the investors. For that, it has to incur some expenses. That expenses are initial expenses. Initial expenses. For example, if you see the question number 1, Mr. A can earn 16% by investing in equity shares on his own. By investing on his own, he can earn 16%. But now he is considering a recently announced equity-based mutual fund scheme in which initial expenses are 5.5%. What is this 5.5? So mutual fund, even though it is collecting 100 rupees from Manoj, ultimately it is going to receive only 94.5 because initial expenses are 5.5. So to collect money from the investors, mutual fund has to pay money to the brokers. Mutual fund has to pay money for advertising agencies. It has to spend money on advertisement. So that's why ultimately it is going to receive only what? 94.5. And annual recurring expenses, every year it has to incur 1.5%. 1.5%. How much should the mutual fund earn to provide Mr. A return of a 16%? How much should the mutual fund earn to provide Mr. A return of a 16%? Okay. For suppose if a mutual fund is going to earn a same 16%, Okay, is it enough? Is it enough to meet the expectation of Manoj, Mr. A? Answer is no. Why? If I collect 100, ultimately I receive only what? 94.5. Why? Because initial expenses are 5.5. So ultimately we receive only what? 94.5. Okay. So if 16% is earned on 94.5, 94.5 into 16%. What is the 94.5 into 16%? 94.5 into 16%. 15.12. So 15.12, yes or no? So 94.5 into 16%, 15.12. So Mr. A can earn 16% by investing on his own. On 100 rupees, he can earn 16%, means 16 rupees. But here, ultimately, the mutual funds receive only what? 94.5. On that 94.5, 16% will not be enough to meet the expectation. Okay. And also, we are incurring a recurring expenses of 1.5%. Every year, we are going to incur 1.5%. So that's why, what is the return to be earned by the mutual fund? Return to be earned by the mutual funds is equal to, that is R2 is equal to R2. R2 means return to be earned by the mutual fund. Return to be earned by the mutual funds. R2 is equal to R1 divided by, R1 means what? What he can earn on his own, divided by 1 minus initial expenses. 1 minus initial expenses. 1 minus initial expenses. Why 1 minus initial expenses? Because we are investing only 0.945. Okay. So that's why mutual fund has to earn 0.16 on 0.945. So R1 divided by 1 minus initial expense plus recurring expense. So that has to be earned. So overall, the mutual fund has to earn 18.43%. If a mutual fund earning 18.43, in 18.43, recurring expenses will be 1.5. Recurring expenses 1.5. What is left out? 16.93. Okay, so mutual fund 0.945 into 16.93%, you will get 0.16. 0.16. So we can meet the expectation of Mr. A. We can satisfy Mr. A. Are you getting my point? So mutual fund has to earn 18.43. So if it earns 18.43, recurring expenses 1.5%. What is left out? 16.93%. But this 16.93% is on 0.945. If you apply the 16.93% on 0.945, you will get 0.16, which Mr. A is earning on his own. So we can meet the expectation. Okay. So what is the formula for R2? R2 is equal to R1 divided by 1 minus initial expense plus recurring expenses. So this is a basic one. So we have only one question. Only one question. The next concept, front end load and back end load. Front end load, back end load. What is this front end load? Front end load means the charges levied while issuing the units. So front end load means what? Charges which are levied at the time of issue. Back end load means what? These are the charges levied at the time of redemption. At the time of redemption. So these are the two different questions. Simple questions only. The unit price of equity linked savings scheme of a mutual fund is 10 rupees. What is the unit price? 10. The public offer price of the unit is 10.204. The unit price is only 10 rupees, but the public offer price is 10.204. That means that extra 0.204 is front end load. These are the charges collected by the mutual fund at the time of issue. So what are the front end charges? Front end load 0.204. So what is the percentage? If I have to say it in percentage, 10.204 minus 10 divided by 10. So nothing but public offer price minus net asset value divided by net asset value. You will get 2.04%. Likewise, back-end load. Back-end load means these are the charges collected at the time of redemption, repayment. What is the redemption price? 9.8. Unit price is 10. So that means what are the back-end charges? Back-end load is 0.2. 10 minus 9.8. 10 minus 9.8, 0.2. If I have to say in percentage, 0.2 divided by 10. So 2%. So how do I get back-end load? Back-end load is equal to net asset value minus redemption price divided by net asset value. Clear? Okay. So see the next third question. So we have completed formulas, mutual fund related formula. See the third question. So this is to understand how the fund manager is paid. How the fund manager is paid. This question. ANP plan, a hedge fund currently has a portfolio, has assets of rupees 20 crores. Okay, the fund is having 20 crores. CAX, Chartered Accountant X, the manager of fund, charge fee of 0.1% of a portfolio asset. He charges a fee 0.15% of a 0.1% of a portfolio asset. 0.1% of a portfolio asset means what is the portfolio asset? 20 crores. So 20 crores into 0.1%. 20 crores into 0.1%. 20 crores into 0.1%, you will get 2 lakhs. So that means the charges levied by a chartered accountant is 2 lakhs. Outrightly, CA will be taking 2 lakhs. Okay. So apart from this 2 lakhs, in addition to it, he charges incentive fee. In this question, this is a special point I have highlighted in the workbook. So in addition to this, he charges incentive fee of 2%. He charges incentive fee 2%. What is the incentive fee 2%? How it is paid? The incentive will be linked to gross return each year in excess of the portfolio maximum value since the inception of the fund. You have to focus on this sentence. How the incentive is paid? Incentive is linked to gross return each year in excess of the portfolio maximum value since the inception of the fund. Inception means what? Beginning. Okay. Since the inception of fund, since the beginning of the fund. What is the maximum value of fund? The maximum value of the fund achieved so far since the inception of a fund about 1.5 years ago was rupees 21 crores. Since the beginning of the fund, what was the maximum value achieved? The maximum value achieved was 21 crores since the beginning of the fund. So read the sentence again. The incentive will be linked to gross return each year in excess of portfolio value since the inception of a fund. So the incentive will be paid only on excess of the portfolio maximum value since the inception of a fund. So what is the maximum value since the inception of fund? 21 crores. For suppose if the value of a fund achieved is 20.5 crores, then no incentive will be paid. But for suppose the portfolio value achieved is 25 CR. So what was the maximum value achieved since the inception of fund? 21. But now we achieved 25. What is the excess value? 25 minus 21, 4 CR. On that 4 CR, 2% will be paid. Nothing but incentive will be paid only if the fund performs well. So here the agreement is what? 2% is paid on excess of the maximum value achieved so far. So what is the maximum value achieved so far? 21 CR. So you are required to compute the fee payable to CAX If return on the fund is, if the return on this fund turns out to be first case 29%, second case 4.5%, third case minus 1.8%. If the return on the fund is, if the return on the fund this year turns out to be 29%, second 4.5 minus 1.8. See the first case. In first case, what is the return? 29%. 29%. What is the current value of fund? 20 crores. So what is the new fund value? The return on the fund is 29%. 29%. So that means the new fund value is equal to 20 crores plus what? 29%. Because return on the fund is 29%. Return on the fund is 29%. So 20 crores into 129%. 20 crores into 129%. 25.8 crores. So 25.8 crores. Clear? So 25.8. What was the maximum value achieved so far? 21. What is the excess value? 25.8 minus 21. 4.8. On that 4.8, we pay 2%. So 4.8 crores into 2%. 9,60,000. So this 9,60,000 is the incentive. But the basic charges are paid. What are the basic charges? 20 crores into 0.1%. 2 lakhs. Overall amount to be paid in first case is 11,60,000. So 11,60,000 will be paid to CA Mr. X, a fund manager. So this is how the fee is payable to the fund manager in mutual funds. Clear? Second case. What is the second case? Second case, return on the fund is 4.5%. Return on the fund is 4.5%. If the return on the fund is 4.5%, if the return on the fund is, okay, if return on the fund is 4.5%, then what? 20 crores plus 4.5% or 20 crores into 104.5%. 20 crores into 104.5%, that is 20.9 crores. But what was the maximum value? 21. So there is no excess value. That means no incentive will be paid. Only the basic charges are paid. What are the basic charges? 2 lakhs will be paid. Only 2 lakhs fee will be paid in second case. What about the third case? A return on the fund is minus 0.8%, minus 1.8% return on the fund. Minus 1.8% means, okay, so are we going to pay any incentive? Kodtaru. Endukani? So here the value has not got increased, value decreased. So that means only the basic charges are paid. What are the basic charges? 2 lakhs. Clear? Okay. So these are the questions from Smart 4. So the questions will look like same. That is NAV concept and what? Holding period return concept. How do we get holding period return? NAV 1 minus NAV naught plus. Okay. So Smart 4, you can do it on your own. See the question. An investor purchased 300 units of a mutual fund at rupees 12.25 per unit on 31st December. On 31st December, he purchased how many units? 300. What is the rate? 12.25. What is this 12.25? NAV not. NAV at the beginning. As on 31st December 2010, he has received 1.25 as a dividend. He received 1.25 as dividend, 1 rupee as a capital gain, distribution per unit. So that means during the year he received 1.25 and 1 rupee, total 2.25 per unit. Total 2.25 per unit. Okay. Required. The return on the investment. The return on the investment. If the NAV as on 31st December 2010 is 13 rupees. As on 31st December 2010, what is the NAV? 13 rupees. What is this 13? NAV 1. What about 12.25? NAV not. Okay. So tell me, what is the holding period return? Return on investment. Return on investment is equal to 13 minus 12.25 plus 2.25 divided by 12.25. So these are the examination questions. These are the examination questions. The weightage of this chapter is 11 to 12 marks. Easy chapter. So 13 minus 12.25 plus 2.25 divided by 12.25. 0.245, nothing but 24.5%. 24.5% return on a investment. Clear? So we are calculating the holding period return on a per unit basis. Instead of per unit basis, you can take for 300 units. 300 units means what? You take 300 into 13 minus 300 into 12.25 plus 300 into 2.25 divided by 300 into 12.25. Clear? So first case. Okay, so 24.5%. Next, see the next one, second part. What is the second part? The return on an investment as on 31st December 2010. Again, they are asking you to find out the return on investment. If all dividends and capital gains distributions are reinvested into additional units of the fund at rupees 12.5 per unit. So this plan is called as a dividend reinvestment plan. So dividend reinvestment plan means nothing but whatever the dividend we receive, okay, we again reinvest in the same mutual fund. We reinvest in a same mutual fund. Example, what happened here? All the dividend and capital gain distributions are reinvested into additional units of the fund at rupees 12.5 per unit. So the entire amount. What is the amount received? 2.25 per unit. 2.25 per unit. How many units we have? 300 units. So that means overall dividend received is equal to 300 into 2.25. 675. So this entire 675 rupees reinvested into mutual funds at the rate of 12.5 per unit. 12.5 per unit. That means how many units are we going to buy? 675 divided by 12.5. 54. 54. Getting my point? So now I cannot apply the previous formula, that is NAV1 minus NAV0 plus income divided by NAV0. Why? Because entire income is reinvested. So in this case, how do I find out the return on an investment? Okay. No income received because income is reinvested. Income is reinvested. See how many units are added? 54 units. Okay. So what is investment value at the end? Investment value at the end is equal to, in the beginning I have a 300 units plus 54, 354 into, what was the NAV at the end? 13 rupees. 13 rupees is the NAV at the end. So 354 into 13. 4602 is the 4602. What is this 4602? Value of the investment at the end. Clear? Here I cannot do on per unit basis. Why I cannot do on a per unit basis? Because number of units at the beginning, at the end are not same. Okay. So what is the value of investment at the beginning? What is the value of investment at the beginning? Value of investment at the beginning is equal to 300 units into 12.25. 3675. Clear? 3675. Now the return is equal to, simple, value of investment at the end minus value of investment at the beginning divided by value of investment at the beginning. So 4602 minus 3675 divided by 3675. 25.22%. Is it clear? Are you able to understand this? So 25.22% per annum is the answer. Okay. See the next question. Smart 5. On 1st April 2009, Fair Return Mutual Fund has the following assets and prices at 4 p.m. 1st April 2009 information is given. A Limited, B Limited, C Limited, D Limited, E Limited, number of shares and market price per share are given. Number of units 8 lakhs. Please calculate NAV of the fund on 1st April 2009. On 1st April 2009, they are asking you to find out the NAV of the fund. How do I get NAV per unit? NAV per unit is equal to total assets minus outside liabilities divided by number of units outstanding. So in case of mutual funds, assets means what? Investment in securities, investment in shares, yes or no? Here is investment is made in 5 companies. Number of shares are given, market price is given. How do I get NAV per unit? Simple. Total assets minus outside liabilities. Here outside liabilities 0. No liabilities are given. Only assets are given. So total assets divided by what? Number of units. So simple. So company, number of shares, market price per share, market value. What is the total market value? 9 crore 52 lakh 38,000 divided by 8 lakhs. 119.05 is the NAV per unit. Is there any complication in this first part? No complication, simple. So total assets divided by what? Number of units. So first part is clear. But in this question, the special part is second part. So whatever the questions we discussed in this session, all the questions are smart. That means we have to refer, need not practice. B part, assuming that on 1st April 2009, Mr. X, a HNI. HNI means high net worth individual. High net worth individual. Like Navneet. Mr. X, a HNI, send a check of rupees 50 lakhs to the fund. And the fund manager immediately purchases 18,000 shares of C Limited and the balance is held in bank. Then what will be the position of the fund? So this is an open-ended fund. This is an open-ended fund. That's why on 1st April what happened? Mr. X, a high net worth individual, send a check of rupees 50 lakhs to the fund. Okay, nothing but Mr. X invested rupees 50 lakhs in fund. And fund manager immediately purchased how many shares? 18,000 shares of C Limited. And the balance is held in bank. Then what will be the position of the fund? Simple, number of shares will remain same or what? So right now how many shares are there? C Limited. C Limited we have a 10,000. Now this 10,000 shares will increase to 28,000. Now these 10,000 shares will increase to what? 28,000 shares. 28,000 shares. So is there any other change? Yes, cash. Cash is the special point. What is the cash here? What is the amount we are taking from Mr. X? 50 lakhs. How many shares are we purchasing? 18,000 shares. What is the market price per share? 264.4. 2 lakh? So 50 lakhs minus, what is the cash balance? Cash balance is equal to 50 lakhs minus 18,000 into 264.4. Clear? Okay. So students might forget this cash balance. Be careful. So they will consider this 28,000. Number of shares increased from 10,000 to 28,000. Manoj Baloch. Manoj Kumar Sharma. So 28,000. So students generally what? They might consider this 28,000, may forget this cash balance. What is the cash balance? 50 lakhs minus 18,000 into 264.4, 2 lakh 40,800. So this 10 crores, 2 lakhs 38,000 is the NAV of the fund. Nothing but NAV of the fund will increase by 50 lakhs. NAV of the fund will increase by 50 lakhs. Charan, NAV of the fund will increase by what? 50 lakhs. Am I clear? Are you getting my point? Okay. So one more mistake you might commit is the number of units. Number of units you might take the same 8 lakhs. But we cannot take same 8 lakhs. Why we cannot take same 8 lakhs? Because Mr. X is investing 50 lakhs. Mr. X is investing 50 lakhs. So we have to issue units to Mr. X. The number of units will not remain same. We are taking investment from Mr. X. That means we have to what? Issue number of units. So that's why number of units is equal to what? 8 lakhs plus 50 lakhs divided by 119.05. So 8 lakh 42,000. So the number of units will increase to 8 lakh 42,000. And NAV per unit will remain same, 119.05. In the question, so at what price the units are issued is not mentioned. If a question is silent about issue price, we assume that units are issued at the NAV on that particular date. On 1st April, NAV was 119.05. So we assume that the new units are issued at 119.05. Clear? Okay. Next, see the third part. Manasa. Now suppose on 2nd April. Now on 2nd April, that is next day at 4 p.m., the market price of shares is as follows. Then what will be the new NAV? Simple. The market prices are changing, yes or no? So then NAV will be changing. Simple. We take the table again. Company A Limited, B Limited, C Limited, DE, number of shares, the new market price per share, the new market price per share, nothing but the market price per share as on 2nd April, and market value. Clear? Okay. So NAV will change. Are you able to understand the last part? So the last part is what? Simple. The market prices are changing. If market price changes, then what? NAV will also change. So NAV is increasing to what? 122.075. Okay. After Smart 6, break this, okay? See the next question, Smart 6. Manoj, Baloch. Smart 6. Smart 6. A mutual fund made an issue of 10,000 units of rupees 10 each on January 1, 2008. How many units are issued, Harshita? 10,000 units at the rate of rupees 10 each on January 1, 2008. So that means what is the amount collected? Kavya. What is the amount collected? 10,000 into, so 10 lakhs into 10. For 10 lakhs into 10, you are using calculator. ఏం చెప్తాం? మీ అక్క కొడుకుని అడిగారు అనుకోండి, లేదా అన్నయ్య పిల్లల్ని అడిగారు అనుకోండి, చెప్తారు 10 into 1 ఎంత అంటే. Okay, so 10 lakhs into 10 is equal to what? 1 crore. So we are collecting 1 crore. No entry load was charged. No entry load was charged. It made the following investment. It made the following investments. 50,000 equity shares of rupees 100 each at the rate of 160, 80 lakhs. 7% government securities, 9% debentures unlisted, 10% debentures listed. Overall 98 lakhs. Overall 98 lakhs was invested. What was the amount collected? 1 crore. 98 lakhs invested. That means 2 lakhs cash. 2 lakhs cash balance. Okay. So this is the answer as per CA final study material and also CMA final past paper and CA final past paper. Okay. But in CMA final study material, you might find a different assumption. 2 lakhs can be assumed as a issue expenses. 2 lakhs can be assumed as issue expenses. So we can take two assumptions. Okay, but I would recommend you to take a cash balance 2 lakhs. But what is the other assumption? Issue expenses. At the time of issue, we spent the 2 lakhs. So that's why we are able to invest only 98 lakhs. Okay, but in this question, we are assuming cash balance 2 lakhs, only 98 lakhs invested. During the year, dividend of rupees 12 lakhs were received on equity shares. What is the amount received? Dividend 12 lakhs. Interest on all types of a debt securities was received as and when due. Interest on all types of a debt securities was received as and when due. So what is the interest amount? 8 lakhs into 7%. Government securities. 8 table, 56,000. Next, 5 lakhs into 9%, 5 table, 45,000. Next, 5 lakhs into 10%, 50,000. So this is the interest collected. Apart from interest, we collected what? Dividend. Okay. So in this question, the special point is at the end of every year, equity shares and 10% debentures are at the end of year. So at the end of the year, the equity shares and 10% debentures are quoted at 175% and 90% respectively. Debentures are quoted at 90%. Debentures are quoted at 90%. 10% debentures. 10% debentures are quoted at 90%. That means by the end of the year, the 10% debentures value will decrease to 5 lakhs into 90%. That is 4 lakh 50. 4 lakh 50. Okay. Other investments are at par. That means 7% government securities and 9% debentures value will remain same. That is 8 lakhs and 5 lakhs. Find out the NAV per unit. Find out the net asset value per unit. Given that operating expenses paid during the year amounted to 5 lakhs. Assume that operating expenses are paid amounted to 5 lakhs. And also find out the NAV. If the mutual fund had distributed a dividend of rupees 0.8 per unit during the year to the unit holders. Simple question. This question was a past question. Okay. What is the amount collected? Navneet. CMA Navneet. What is the amount collected? 10 lakhs into 10. 1 crore. Okay. What is the amount invested? 98. What is the cash balance? 2 lakhs. 2 lakhs cash. In the beginning itself we have a 2 lakhs cash. Yes or no? So 2 lakhs cash. Okay. I have to find out NAV at the end. How can I find out the NAV at the end? NAV at the end. Total assets minus outside liabilities. I should take the total assets. Total assets. So first asset is equity shares. What is the first asset? Equity shares. Equity shares at the end are quoted at 175%. At the end, equity shares are quoted at 175%. So here this is a special point because students might take 80 lakhs into 175%, which is not correct. We should not take 80 lakhs into 175%. Here that 175% meaning is equity shares are quoted at 175% of a face value, not 175% of the existing market price. 175% of the face value. Nothing but we should take what? 50,000 into 100 into 175%. So this is the only special point in this question. 50,000 into 100 into 175%. You will get 87 lakh 50,000. So the new equity value is 87 lakh 50,000. Okay. What is the next one? 7% government securities. Other investments are at par. So that's why take only 8 lakhs. 9% debentures take only 5 lakhs. But 10% debentures are quoted at 90%. So that means we should take 4 lakh 50. We should take 4 lakh 50,000. Clear? So 4 completed. 87 lakh 50. Okay. 87 lakh 50. 5 lakhs. 8 lakhs. 4 lakh 50. But the most important point, cash. What is the other asset we are having? Cash. Initially we had a 2 lakhs cash. Meanwhile we received a dividend of 12 lakhs. 2 lakhs plus 12 lakhs, 14. Plus interest, 56. Interest 56 on government securities. Yes or no? 8 lakhs into 7%. Plus 5 lakhs into 9%. 45. Plus 5 lakhs into 10%. 50,000. Minus operating expenses. 5 lakhs. Clear? So what was the cash balance at the beginning? 2 lakhs. Dividend received 12 lakhs. Interest on government securities 56. Interest on 9% debentures 45. Interest on 10% debentures 50. Less operating expenses 5 lakhs. What is the cash balance at the end? 10 lakh 51,000. I am adding that cash balance 10 lakh 51,000. So I am getting NAV This is the NAV before distribution of a dividend. Mutual fund received a dividend. Mutual fund received dividend that included in cash. Okay, so this 1 crore 15 lakh 51,000 is the NAV before distribution of a dividend. But here two questions are asked. One is NAV per unit. Okay, and again also find out the NAV if the mutual fund had distributed a dividend of rupees 0.8 per unit during the year to the unit holders. Simple. One is before declaration of dividend and the second is what? After declaration of a dividend. So before declaration of dividend, NAV is equal to 1 crore 15 lakh 51,000 divided by 10 lakh units, 11.55. After declaration of dividend, 1 crore 15 lakh 51,000 minus 8 lakhs. So that is 1 crore 7 lakh 51,000 divided by 10 lakhs. So the answer is 10.751. So this is the NAV per unit. Clear? Okay. So are you able to understand this mutual fund concept? See the next question in mutual funds, Smart 7. Based on the following information, determine the NAV of a regular income scheme on per unit basis. Listed shares at cost, ex dividend, cash in hand, bonds and debentures at cost. Of these bonds not listed and quoted. Of these bonds not listed and quoted, 1. Other fixed interest securities at cost, dividend accrued, amount payable on shares, expenditure accrued, number of units rupees 10 face value, current realizable value of fixed income securities of face value of rupees 100 106.5. This is the special point. The listed shares were purchased when index was 1000. Present index is 2300. Value of listed bonds and debentures at NAV date. At NAV date. Okay, there has been a diminution of 20% in unlisted bonds and debentures. Other fixed interest securities are at cost. So go through the question once. See the solution. So what is the question? They are asking you to find out the NAV per unit basis. What is the first one? Listed shares at cost given. So 20 crores. What was the index when the investment was made? 1000 and the present index is 2300. So that means what happens to the equity share value? Equity share value increases 20 crores into 2300 divided by 1000. Clear? Now, cash in hand. Cash in hand. So what is the cash in hand here? 1.23. 1.23 cash in hand. Okay. Next, bond and debentures at cost. Bond and debentures at cost. Bond and debentures at cost. 1 minute. Okay, see the next one. Bond and debentures at cost 4.3. But of these bonds not listed and quoted, 1. Unlisted bonds, 1. There has been a diminution of 20% in unlisted bonds. That means the value is zero point 0.8. How do we get NAV? Total assets minus outside liabilities. Okay. So you should take a zero point 0.8. What about the listed bonds? Listed bonds. The cost of a listed bonds is 4.3 minus 1, 3.3. But the value of a listed bonds is given at the end, 8. So 8 taken. Clear? The next, other fixed interest securities at cost. Other fixed interest securities at cost. This is a special point. Why this is a special point? Because in between, a confusing information is given. Current realizable value of a fixed income securities of face value rupees 100 is 106.5 crores. Okay. So that information you have to ignore. Why, sir? Simple. 4.5 crores worth of fixed interest securities at cost cannot be 106.5 crores. Okay. Later on, other fixed interest securities are at cost. Other interest other fixed interest securities are at cost. Information is given, right? Dividend accrued is also an asset. Point 0.8. Point 0.8. Clear? So total assets 61.33 minus amount payable on shares. So we might have subscribed for shares. So you have to pay. We have to pay first call money or second call money. Amount payable on shares 6.32. Expenditure accrued 0.75. Okay. So total liabilities 7.07, and the net assets is equal to 54.26 crores. NAV is equal to 54.26 crores divided by 20 lakhs. So the answer is 271.3. Clear? Okay. Next, let us move on to the next question. Smart 8. On 1/4/2012, be careful in Smart 7. Only one point is the special point. Current realizable value of a fixed income securities of face value rupees 100. That point we have to ignore. Okay. I will share the compilation in next 1 to 2 days. 1 to 2 days, I will be sharing a CA final compilation, past paper compilation, chapter wise compilation. You go through the past examination questions so that you will understand the examination standard. Okay. See the next question, Smart 8. On 1/4/2012, mutual fund issued 20 lakh units at rupees 10 per unit. Relevant initial expenses involved were rupees 12 lakhs. It invested the funds so raised in capital market instruments to build a portfolio of rupees 185 lakhs. During the month of April 2012, it disposed of some of the instruments costing rupees 60 lakhs for rupees 63 lakhs and used the proceeds in purchasing securities for rupees 56 lakhs. Fund management expenses for the month of April 2012 was rupees 8 lakhs, of which 10% was in arrears. In April 2012, the fund earned dividend amounting to 2 lakhs and it distributed 80% of the realized earnings. On 30 April 2012, the market value of the portfolio was rupees 198 lakhs. Mr. Akash, an investor, subscribed to 100 units on 1/4/2012 and disposed of the same at closing NAV 30 April 2012. What was his annual rate of earning? So to find out annual rate of earning, first we should find out the holding period return. He purchased 100 units on 1st April and he disposed of on 30th April. Holding period is 1 month. For this holding period, we should find out the holding period return. How do we get holding period return? NAV1 minus NAV naught plus income divided by NAV naught. So NAV naught, simple, NAV naught is already given in the first sentence, 10 rupees per unit. 20 lakh units are issued on 1st April at rupees 10 per unit. NAV naught is given. We have to find out NAV1. How do we get NAV1? Net asset value at the end divided by number of our units. Simple. How do we get NAV at the end? Total assets minus outside liabilities. So, simple question. 20 lakhs into 10. What is the amount collected? 200 lakhs. Out of 200 lakhs, 12 lakhs initial expenses. Let us find out the cash position. So, 200 minus 12, 188 lakhs. So, with 188 lakhs, fund invested 185. That means the cash left is 3. Cash left is 3. So during the month of April, it disposed of some of the instruments costing 60 lakhs for rupees 63 lakhs. That means we received 63. 3 plus 63, 66. And used the proceeds in purchasing securities for rupees 56 lakhs. Minus 56. The cash balance is 10. Fund management expenses for the month of April 2012 was rupees 8 lakhs, of which 10% was in arrears. So that means 7.2 lakhs fund management expenses. So 10 minus 7.2, 2.8 lakhs is the cash balance. In April 2012, the fund earned dividend amounting to 2 lakhs. So 2 lakhs plus 2.8, 4.8 lakhs is the cash balance. It distributed 80% of its realized earnings. This is a special point. It distributed 80% of the realized earnings. So what are the earnings here? 2 lakhs dividend and cash capital gain. Here the capital gain. What is the capital gain? We sold investment worth 60 lakhs for rupees 63. So 3 lakhs capital gain, 2 lakhs dividend. So total 5 lakhs. Out of 5 lakhs, 80% distributed. That means 4 lakhs. So 4.8 lakhs cash balance minus 4 lakhs, 0.8 lakhs is the cash balance. Okay, so why we should find out the cash balance? To find out the NAV at the end. What is the market value of a portfolio at the end? The market value of the portfolio at the end is 198 lakhs. So that means NAV at the end is equal to market value of a portfolio 198 plus cash balance point 0.8 minus fund management expenses 10% was in arrears. That is a liability. 8 lakhs into 10%, 0.8 is a liability. So that means overall NAV is equal to overall. So this is the cash balance 0.8. Overall NAV is equal to 198 plus cash balance zero point 0.8 minus outstanding, okay, expenses 0.8. So NAV at the end is equal to 198 divided by 20 lakhs. What is the number of, what is the NAV per unit? NAV per unit is equal to 9.9. NAV per unit is equal to 9.9. Clear? Are you able to understand? What is NAV per unit? 9.9. Let us find out the holding period return. How do I get holding period return? NAV 1 minus NAV naught plus income. Okay. So what is the NAV at the beginning? He bought 100 units. 100 into 10. 1000 rupees is investment at the beginning. What is the value of investment at the end? 100 into 9.9. So 990. Okay. He received income. What is the income received? 4 lakhs. 4 lakhs is the income distributed. For how many units? 20 lakh units. 4 lakhs divided by 20 lakhs into this person is having 100 units. So that's why what is the income received? 20. Clear? Huh? So what is the holding period return? 990 minus 1000 plus 20 divided by 1000. 1% per month. So annual rate of a return is equal to 1 into 12. 12% is the answer. Clear? So in this question, the special point is finding out the cash balance, and the point to be noted is 80% of the realized earnings distributed. Clear? Next, let us move on to the next question. Smart 9. Mr. Sinha has invested in 3 mutual funds as per details below. Particulars: Scheme X, Scheme Y, Scheme Z. Date of investment, amount of investment, net asset value at entry, date, dividend received up to 31st March 2009, NAV as at 31st March 2009. You are required to calculate the effective yield per annum basis in respect of each of the 3 schemes to Mr. Sinha up to 31st March 2009. So effective yield means return. So they are asking you to find out the annual rate of a return. How can we find out the annual rate of a return? Simple. NAV 1 minus NAV naught. What is the NAV at entry date? In first case 10.5. This is the NAV at the end. Yes or no? NAV 1 minus NAV naught plus income. But income is given in total basis. Okay, total dividend is given. So we have to find out the per unit dividend and can find out what holding period return and then what annual rate of a return. Or else take the total NAV at the beginning, NAV at the end. Total dividend is given. You can find out the holding period return on per unit basis or a total basis. Clear? Simple question. Simple question. What is the investment? 5 lakhs. 5 lakhs divided by 10.5. You will get number of units. How many units? 47,619.05. Clear? What is the NAV as at 31st March 2009? 10.4. That means this is the total NAV at the end. Total NAV at the end is equal to 47,619.05 into 10.4. 4,95,238.12. Dividend 9,500. So what is the calculation for mutual fund X? Simple. How do we got this 0.95%? 0.95%. Check the number whether it is correct or not. 4 lakh 95,000 238.12 minus 495 238 minus 5 lakhs plus what? 9,500 divided by what? 5 lakhs. Divided by 5 lakhs. What is the answer? Okay, 0.95. 0.95. 0.95 is for how many months? What is the investment date? Investment is made on 1st December. But they are asking you to find out the effective yield per annum up to 31st March 2009. That means what is the holding period? Holding period is 4 months. Okay. So return per annum is equal to 0.95 into 12 divided by 4. So the answer is 2.85. Clear? In the same manner, we have to find out what for mutual fund Y and mutual fund Z. Okay. I'm moving on to the next question. See the next question. Super one. This is the first question to be practiced in mutual fund chapter. Mr. Y has invested in 3 mutual funds as per the following details: particulars, mutual fund X, mutual fund Y, mutual fund Z. Amount of investment, net asset value at the time of purchase, dividend received up to 31st March 2018, NAV as on 31st March 2018, effective yield per annum as on 31st March 2018. This time effective yield per annum is given. What is effective yield? 9.66 minus 11.66, 24.15. In previous question, they asked you to find out the effective yield. Assume 1 year is equal to 365 days. Mr. Y has misplaced the documents of his investment. Help him in finding the date of his original investment after ascertaining the following. Okay. So in single entry and in mutual funds, generally in CA question, this happens. Okay. So they will have all information. Okay. So they will have everything. Okay. But see, the irony is he does not know when he made an investment. He can see his bank statement, right? Okay. After ascertaining the following, help him in finding the date of his original investment. We have to find out the date of original investment. But before that, we have to find out number of units in each scheme, total NAV, total yield, and number of a days investment held. Simple question. First, we should find out the number of a units in each scheme. First part is simple. What is the amount of investment? 2 lakhs divided by 10.3. 2 lakhs divided by 10.3. You will get number of a units. Yes or no? How many units? Okay, 19, 4, 17.48. Likewise, we have to find out the number of units for what? Mutual fund Y and mutual fund Z. Clear? Mutual fund X, Y, and Z. Okay. Next, total NAV. They are asking you to find out the total NAV. So, total NAV means they are asking total NAV at the end. How do I get total NAV at the end? Number of units into closing NAV. So, I have calculated for mutual fund Y, X, Y, and Z. So, the total NAV. Okay, there is no clarity in question, so that's why the overall NAV is also calculated. The overall NAV is 7,99,068.77. Okay, now what is the next part? Yield, yield, total yield. So let us find out the total yield. So we have to find out yield for X, Y, and Z. Okay, in the question bank for X, Y, and Z it is missing. Let us find out. Simple. How do I get NAV at the end? What is NAV at the end? 1 lakh 99,029 minus what is the NAV at the beginning? 2 lakhs plus what is the dividend? 6,000 divided by what? 2 lakhs. Okay, this is the yield on mutual fund X. What about the mutual fund Y? How much are we getting from mutual fund X? What is the number? 2.81 for a 2.814 or 2.514? 1 lakh 99,029 minus 2 lakhs plus 6,000. Now 1 lakh 99,29 minus 2 lakhs plus 6,000 divided by 2 lakhs. 2.81. 2.81, huh? 2.514 percentage. What about the second one? Second calculation, 3 lakh 96,040. 396040 minus 4 lakhs plus what is the dividend amount? 0 divided by 4 lakhs. Here we are going to get negative minus 0.99%. Okay, what about last one? 2 lakh 4,000 minus 2 lakhs plus dividend 5,000 divided by 2 lakhs. Answer is 4.5%. What are these numbers? These are holding period returns. Holding period returns. So if they ask you to find out the total yield means simple. So this is the capital gain, yes or no? First case capital loss, second case capital loss, and for mutual funds at capital gain. Dividend 6,000 and 5,000. What is the overall gain? 10 lakh. So 10,068 divided by overall investment 8 lakhs. 1.2586% is the total yield, overall yield. Okay. How do I get individual yield? 5029.17 divided by 2 lakhs. 3960.4 divided by 3 lakh 96,039.6. Clear? Are you getting my point? Okay. So every time we used to have a holding period, and we find out holding period return, and using holding period and holding period return, we used to find out annual rate of a return. But in this question, annual rate of a return is given. What is annual rate of a return? 9.66%. Okay. And they are asking you to find out what number of a days the investment held. Simple logic. This 9.66 is for how many years? I mean, per annum. That means how many days? 365 days, not 356, 365 days. 365 days, yes or no? Now the question is for 2.514, how many days? What is the calculation? 2.514 divided by 9.66 into 365. So tell me the number. 2.514 divided by 2.514 divided by 9.66 into 365. 95 days. Second calculation, minus 0.99. Okay, effective yield per annum is minus 11.66. Minus 0.99 divided by minus 11.66 into 365. 31 days. Last case, 4.5 divided by 24.15 into 365. 68 days. So one thing is missing in the answer, that is original investment, date of original investment. So fifth part is missing. Date of original investment. What is the date of original investment? Date of original investment. So first, what is the first one? How many days? 95 days, right? Okay. So we are the month of March. Effective yield as on 31st March is given, right? Okay. So 95 days. In March 31. What about February 28? January 31. 90. So another 5 days. In December, another 5 days. Holding period. That means December 26th or 27. 27. 27, 28, 29, 30, 31. So 27 December is the date of original investment for mutual fund X. What about mutual fund Y? What is the holding period? Mutual fund Y. 31 days. That means 1st March. Mutual fund Y. What about mutual fund Z? What about mutual fund Z? 68. 68 means 31 and 28. 31 and 28. So 59. Another, how many days? 9 days. 9 days means 22nd or 23rd. 23rd, 23, 24, 25, 26, 27, 28, 29, 30, 31. So 23rd. 23rd January is the date of original investment. Am I clear? Done. Okay. Shall we move on to the next question? Super 2. Second question to be practiced. Mr. X on 1/7/2012, during the initial public offer of a mutual fund, invested 1 lakh at face value of rupees 10. So this question is for practice. Investment is made on 1st July, 1 lakh rupees, face value 10. On 31st March 2013, the mutual fund declared a dividend of 10%. When Mr. X calculated that his holding period return was 115%. On 31st March 2014, mutual fund again declared a dividend of 20%. On 31st March 2015, Mr. X redeemed all his investment, which had accumulated to 11,296.11 units when his holding period return was 202.17%. Calculate the NAVs as on 31st March 2013, 31st March 2014, and 31st March 2015. This question is for practice. You will find a similar question in CA final study material. Instead of giving a holding period return 115%, instead of giving a holding period return 115 percentage, so they will be giving a annual rate of a return. So they will be giving what? A annual rate of a return. In both cases, instead of 115 and 202.17%, they will be giving an annual rate of a return. First case, instead of 115, they will be giving 153.33. 153.33. In second case, they will be giving what? Okay, instead of 202.17%, they will be giving 73.52 percentage. Okay. So see the solution for this question. Super 2. This question is for practice. Second question to be practiced. Okay. So what is this? Be careful. This is a reverse working question. On 1/7/2012, during the initial public offer, invested 1 lakh at a face value of rupees 10. On 31st March 2013, the mutual fund declared a dividend of 10% when Mr. X calculated that his holding period return was 115%. Okay. Okay. So we have to find out NAV as on 31st March 2013. So this is a reverse working question. Okay. Let us start this question. Super 2, right? This question is Super 2. Super 2. So first part, NAV as on 31st March 2013. So every time NAV not and NAV1 will be given in the question, and we used to find out the holding period return and annualized rate of a return. But in this question, holding period return is given. What is the holding period return? 115%. So be careful. Instead of giving holding period return, they might give annual rate of a return 153.33%. Okay. So annual rate of return 153.33. What is the holding period? We invested money on 1st July. 1st July means how many months? What is the holding period? 9 months is the holding period. So if you do 153.33 into 9 divided by 12, you will get 115%. The only change, there is one question in ICAI book. Instead of holding period return 115%, they will give 153.33%. Be careful, okay? So how do we get holding period return? NAV1 minus NAV naught. I do not know NAV1, but I know NAV naught. What is NAV naught? Investment at the beginning 1 lakh plus dividend declared 10%. Dividend declared 10% means 1 lakh into 10%, 10,000 divided by 1 lakh. Clear? So 1,15,000 is equal to NAV1 minus 90,000. NAV1 is equal to, okay, 2,05,000. but they are asking you to find out the NAV per unit. What is NAV per unit? NAV per unit is equal to 2,05,000 divided by how many units are purchased at the beginning? 10,000 units. 1 lakh divided by 10. Yes or no? So that means 20.5 rupees is the answer. NAV as on 31st March 2013. Okay. Next, let us come to the B part. Let us come to the B part. On 31st March 2014, mutual fund again declared a dividend of 20%. Again declared a dividend 20% on 31st March 2014. On 31st March 2015, Mr. X redeemed all his investment which had accumulated to 11296.11 units when his holding period return was 202.17 percentage. Okay. So how many units are redeemed at the end? 11296.11. In the beginning, they have a 10,000 units. How Mr. X redeemed 11,296.11 units? Nothing but he is reinvesting the dividend received. That's why the number of units increased. Okay, clear? So B part, NAV. This part is the special part in this question. NAV as on 31st March 14. What is the clue given? On 31st March 2015, how many units are redeemed? 11,296.11. Okay. First, let the NAV as on 31st March 14 is equal to X. If you have a problem with X, take Y. Let the NAV as on 31st March 14 is equal to X. Okay. Now, see what are the units at the beginning? 10,000 plus on 31st March 2013, we received a dividend of 10,000 and the 10,000 rupees is reinvested. That's why the number of units increased to 11,296.11. So 10,000 divided by, okay, how many units? So I mean, what is NAV on 31st March 2013? 20.5. Okay, plus again on 31st March 2014, the dividend received is reinvested. So all the units are sold on 31st March 2015. Getting my point? 10,000 at the beginning plus on 31st March 2013, how many units are purchased? 10,000 divided by 20.5. That means 487.5. 487.8. Nothing but 488 plus 10,488 into 10 into 20%. This is the dividend received on 31st March 2014. Again, this amount is reinvested. Okay, what is the NAV on 31st March 2014? We assume it as a X. This should be equal to 11,296.11. You will get X is equal to, on solving this equation, you will get X is equal to rupees 25.95. Clear? Are you able to understand the equation? Navina, are you able to understand this equation? Shrikant, are you able to understand this equation? Shravani, Mohan Krishna, are you able to understand this? Done. Next, C part. NAV as on 31st March 15. What is the clue given to find out the NAV as on 31st March 2015? On 31st March 2015, holding period return was 202.17%. What was the holding period return? 202.17%. So 202.17 means 202.0217 is equal to, how do I get holding period return? NAV 1. No idea. Minus NAV not. 1 lakh divided by 1 lakh. Sir, what about the dividend? The entire dividend is reinvested. Yes or no? So that is already included in NAV 1. So now NAV 1 is equal to Value of investment at the end is equal to 3 lakh 2170. NAV per unit is equal to 3 lakh 2170 divided by 11,296.11. Answer 26.75. Clear? Are you able to understand this? Okay, done. Let us move on to the next question. Super 3. Super 3. Sun Moon Mutual Fund approved mutual fund sponsored open-ended equity oriented scheme Chanakya Opportunity Fund. There were three plans: dividend reinvestment plan, B bonus plan, C growth plan. At the time of initial public offer on 1/4/1999, Mr. Anand, Mr. Bachchan, Mrs. Sharu, three investors invested rupees 1 lakh each and chosen B, C, and A plan respectively. The history of the fund is as follows: date, dividend percentage, bonus ratio, net asset value per unit, plan A, plan B, plan C. On 31st July 2009, all three investors redeemed all the balance units. Calculate annual rate of a return to each of the investors. Consider long-term capital gain is exempt from income tax. Short-term capital gain is subject to 10% income tax. Security transaction tax 0.2% only on sale or a redemption of a units. Ignore education cess. Okay, three plans are given. For the three plans, we have to find out annual rate of a return. We have to find out what? Annual rate of a return. Okay, all the three investors redeemed all the balance units. So three plans are there: plan A, plan B, and plan C. Forget about the investor names. What are the investor names? Mr. Anand, Mr. Bachchan, Mrs. Charu. To confuse, they have given chosen plan B, C, and A. So that's why you forget about the investors' names. What is the amount invested? 1 lakh. Okay. What is the first plan? So Super 3, right? Super 3. You will find a similar question, May 23 question. So in May 23 question, NAV at the beginning is not given. You have to assume let the NAV at the beginning is equal to X. So that question I have explained in CMA final OG series. If you have any doubt, you go through that series and understand that question. Okay. I will share the compilation next 1-2 days. Super 3. What is Super 3? Calculation of annual rate of a return. In that first one, what is the first one? Dividend reinvestment. What is this dividend reinvestment plan? Dividend reinvestment means whatever the dividend is received, that is reinvested on the same day at the rate of NAV on that particular date. So let us take the columns. Date. Okay. I'm taking the date. Next what? Dividend. Okay. Next what? Dividend. What are the columns? Date, dividend, opening units. Okay. Next what? Purchase, closing. And in between, let us take NAV. NAV. What is the first date? 1/4/99. Dividend nil. What is the NAV on the date? 10. Opening units nil. Purchase. How many units are being purchased? 10,000. Closing 10,000. Units 10,000. Okay. What is the next date? 28th July 2003. What is the dividend received? 10,000 units into face value 10 into 20%. So that means what is the amount? 20,000. What is the NAV on that date? 30.7. Opening units 10,000. How many units are purchased on the date? 20,000 divided by 30.7. 20,000 is a dividend amount. 20,000 divided by 30.7. What is the number? 651.46. Is it correct? 30.7 is the plan A NAV. Clear? Everybody are able to understand? So how many units? 10,000. 651.46. Clear? 651.46. 10,651.46. What is the next date? 31st March 2020. 2004. What is the dividend amount? 10,651.46 into 10 into 70%, the rate of dividend. What is the amount? 10,651.46 into 10 into 70%. 7 74560. What is the NAV on that date? 58.72. So opening units 10,651.46. The new units purchased. How many units are purchased? 74560 divided by 58.72. 12 was 69.76 total. 11 91.2. Clear? Okay. So that is how you have to find out what NAV, I mean number of units, number of units. So by the end, how many units are there? 14906.16. Clear? So this 14906.16 units, dividend reinvestment plan. We started with 10,000 units, but by the end, okay, by 31st July 2009, number of units will be 14,906.16. What is the NAV on 31st July? NAV on 31st July is equal to 53.75. All the units are redeemed at 53.75. What is the value? 8,01,206.10. Security transaction tax 0.2%. So the net amount received is 7,99,603.69. The long term capital gain is exempt from tax, but short term capital gain is subjected to 10% tax. Yes or no? So short term capital gain is applicable if securities or if mutual fund units are sold within the 1 year. We are selling on 31st July. What was the last purchase? The last purchase was made on 24th March 2009. So the last purchase was on 24th March 2009. Sold on 31st July means sold within a year. How many units? 1144.43. 1144.43. Clear? What about 15th March 2008? 15th March 2008. So that means that is more than 1 year. So short term capital gain is not applicable. Okay. So short term capital gain is applicable only on 1144.43 units. So 1144.43 into 53.75 minus 48.10. What is this 48.10? Cost of acquisition. Clear? So 53.75 minus 48.1 into 10%, 647. This is the net amount after payment of a tax. How do I get holding period return? 7,98,956.69. NAV at the end minus NAV at the beginning 1 lakh divided by 1 lakh. Okay. Then I will get holding period return, but I should find out the annual rate of a return. How do I get annual rate of a return? Holding period return into 12 divided by holding period. What is the holding period? Investment is made on 1st April 1999 and sold on 31st July 2009. That means 10 years plus 4 months. April, May, June, July. So total 124 months. So 67.64% is the answer. Clear? Now, the bonus plan. What is this bonus plan? Instead of dividend, bonus units will be issued to the unit holders. Okay, clear? Done. Are you getting my point? So, are you getting my point? What is the next plan? Bonus plan. We started with how many units? 10,000 units. We started with 10,000 units, and on 31st March 2004, how many units are issued? Bonus issue is made at 5 is to 4. 5 is to 4 means for every 4 units, 5 bonus units are issued. 5 bonus units are issued. That means 10,000 into 5 by 4. 12,500 units are issued. Overall 22,500. And again the next bonus is on 31st March 2008. 1 is to 3. Okay, 22,500 into 1 by 3. 7,500 overall 30,000. And next 1 is to 4. Next ratio. That means 30,000 into 1 by 4. 7,500 overall 37,500. Clear? So now what is the realization? 37,500 into what is the NAV on 31st July? 22.98. So this is the total sale. Minus security transaction tax 0.2%. So this is the net amount received. Minus short-term capital gains tax. Short-term capital gains tax is applicable only on 7,500 units which were bought on 24th March 2009. Okay. For the previous purchase, short-term capital gain is not applicable because 31st March 2008 means more than 1 year. So short-term capital gain is not applicable. And for bonus units, what is the cost of acquisition? 0. For bonus units, cost of acquisition is 0. So that's why 7,500 into 22.98 into 10%. So this is the net amount after tax. So 8,42,791 minus 1 lakh divided by 1 lakh into 12 divided by 124, 71.883% is the answer. Annual rate of a return. Next, growth plan. This is simple. Growth plan means what? Units will remain same. Only NAV will increase. What is NAV at the end? 82.07. How many units at the end we remain with 10,000 units? So 10,000 into 82.07 minus security transaction tax 0.2%. So 8,19,059. So 8,19,059 minus 1 lakh divided by 1 lakh into 12 divided by 124. So the answer is 69.59 percentage. Is it clear, Navina? Okay. Are you able to understand this? Clear? Okay, see the next question. Super 4 question. So this question, the special point is dividend equalization question. Okay. And this question was tested in September 2025. May 25, I'm sorry, May 25. Dividend equalization question. Okay. So one of my student, he committed a mistake despite of warning. Repeated warning, he committed a mistake. So once again, I'm giving a warning. So how this dividend equalization is treated and what is this dividend equalization? Simple question. On 1st April, an open-ended scheme of a mutual fund had 300 lakh units outstanding with NAV 18.75. On 1st April, how many units are there? 300 lakh units, NAV 18.75. At the end of April, it issued 6 lakh units at opening NAV plus 2% load. What is this load? Entry load. Adjusted for dividend equalization. This is the keyword in this question. At the end of May, 3 lakh units were repurchased at opening NAV less 2% exit load adjusted for dividend equalization. At the end of June, 70% of its available income was distributed. In respect of April-June quarter, the following information are available. Particulars, portfolio value appreciation 425.47, income of April 22.95, income for May 34.425, income for June 45.45. You are required to calculate income available for distribution, issue price at the end of April, repurchase price at the end of May, net asset value as on 30th June. Okay. So this question is a simple question. The only new term in this question is dividend equalization. Okay. Sir, what is this dividend equalization? Simple concept, super 4. Super 4. Simple concept. Okay. It is a simple question, easy to understand. No need to worry about this question. Sir, what is this dividend equalization? For suppose, let us assume I'm holding 3 lakh, 300 lakh units. Myself and Sai Charan together holding 300 lakh units on 1st April. Okay. At the end of April, mutual fund issued 6 lakh units. 6 lakh units issued at the end of April. So at the end of April, when the 6 lakh units are issued, Navina is going to purchase this 6 lakh units. Okay. Next, at the end of May, 3 lakh units were repurchased. 3 lakh units were repurchased means what? It's like buyback. Nothing but at the end of May, Sai Charan is leaving the mutual fund. Okay, mutual funds paid money to Sai Charan and 3 lakh units were repurchased. On 1st April, me and Sai Charan together were holding 300 lakh units. At the end of April, 6 lakh units were issued and Navina joined the mutual fund. At the end of May, 3 lakh units were repurchased. Sai Charan was sent out. Sai Charan he sent out. Okay. Now, what is this dividend equalization? Dividend equalization is, if you see this, what is the income of April? 22.95. Income for May, income for June. Okay. This total income for April, May, and June, out of this total income, 70% of available income was distributed at the end of June. Okay. So Navina, she is purchasing at the end of April. At the end of June, income is distributed. What is the income being distributed? Income of April, May, and June. Navina will also get a share in April, May, June income, which is totally unfair. Why? Because Navina, she is purchasing units at the end of April, so she is not entitled to receive the share in income of April. Am I correct? Okay. Second point, Sai Charan, he is leaving the mutual fund at the end of May. He is entitled to income of April, income of May. But this fellow, he is leaving at the end of May. He is not waiting until June. So by when the income is being distributed, yes or no? Which is totally unfair. Navina, even though she is not entitled, she is taking a dividend for it. She is sharing the income of April. And Sai Charan, even though he is eligible for April and May income, he is not getting his share because he is leaving at the end of May. But whereas income is being distributed at the end of June. So that's why to equalize, what we do is, while Navina joining at the end of April, we collect dividend equalization. We collect dividend equalization. Okay, nothing but we collect, like we collect goodwill from incoming partner. We collect dividend equalization from the incoming investor, and we pay dividend equalization to the investor who is going out at the end of May. Nothing but we give the share of April and May to the investor who is going out. Okay, to equalize all, we collect a dividend from the incoming investor, we pay dividend to the outgoing investor. It's like what, taking goodwill from incoming partner and paying goodwill to the outgoing partner. Simple concept. So first one is income available for distribution, first part. Income available for distribution. Particulars, amount. Particulars and amount. Clear? Particulars. What is income of April? Income of April. What is income of April? Simple. What is income of April? 22.95 lakhs. Clear? Okay. Next, at the end of April, 6 lakh units are issued. Additionally, how many units are issued? 6 lakh units. So that means we collect dividend equalization from the incoming investor. Add. So dividend equalization. What is the calculation? 22.95 lakhs divided by how many units are there? 300 lakhs. So 22.95 lakhs divided by 300 lakhs. What is the income per unit? 0.0765 is the income per unit. How many units are being issued? 6 lakh units. So we collect this amount from the incoming investor. Why, sir? Because he is not in the month of April. To equalize already the existing investor and the incoming investor, to equalize both, we are collecting the dividend from the incoming investor to equalize. So this concept is called as dividend equalization. Done. What is the amount? 0.459 lakhs. Total 20 23.409 lakhs. Next, add income of a May. What is income of a May? 30 425 50 57.835 income of a May. Next, what? What is happening at the end of a May? At the end of a May, we are repurchasing 3 lakh units. Okay, at the end of a May, investors are going out. Okay, they stayed with us for April and May, but we are distributing income at the end of a June. By the time we distribute the income, they will go. Yes or no? So that's why we should pay to equalize. We should pay them dividend equalization. Clearer? So what is the calculation? 57.835 divided by 306 lakhs into 3 lakhs. What is the number? 0.567 lakhs. Total 57.267. Add income of June. What is income of June? 45.45. Total 102.717 minus income distributed. What is income distributed? 70%. What is 70% of this 102.717? 71 102.717 into 70%. Calculate now. 102.717 into 70%. Lakhs. So what is the rest of balance amount? 102.717 minus 71.901. 30.816 lakhs. This is the income available for distribution, first part. Let us move on to the second part. What is the second part? Are you able to understand this dividend equalization concept? Issue price at the end of April. Issue price at the end of April. Particulars amount. 6 lakh units at opening NAV. At the end of April, it issued 6 lakh units at opening NAV. So, okay, so opening NAV 18.75 plus 2% entry load. Okay, these are the charges levied by mutual fund 0.375. So we are collecting dividend equalization from the incoming investor. What is the dividend equalization collected? Dividend equalization collected per unit. You have to find out per unit. Dividend equalization collected per unit is equal to 22.95 lakhs divided by 300 lakhs. 22.95 lakhs divided by 300 lakhs. 0.0765. This will be the issue price. 19.2015 is the issue price. Clear? Next, C part. What is the C part? Repurchase price. Repurchase price. Particulars amount. Repurchase price particulars amount. What is the opening NAV? Repurchase is done at opening NAV 18.75. Exit load 2%. Repurchase price 18.75. That means we are paying 18.75 per unit to the outgoing investor. Entry load and exit load are the charges collected by the fund. Clear? So that means what? Add or minus? Minus. So fund will not be going to pay 18.75 to the investor. Fund will be charging the exit load minus exit load at the rate of 2%. 0.37. But we should give him the dividend equalization. Dividend equalization. Be careful. Students might be thinking like, sir, in the above case, entry load added. So here we are reducing. Okay. Opposite, because that is issue and it is repurchase. Dividend equalization, both the cases we have to add. Why, sir? Dividend equalization we are collecting from the incoming investor. That means should be added to the issue price. Here dividend equalization again should be added to the repurchase price because it is being paid to the investor. But exit load and entry load are not same, because entry load or exit load both are collected from the investor. Both are collected. Both are the charges levied. Okay, so that's why we are adding in the above case and reducing in the second case. But dividend equalization, we are collecting from the incoming investor in above case, and in second case we are not collecting, we are paying. So that's why add dividend equalization. What is the calculation? Dividend equalization calculation 57.835. So what is the number? 0.189. So answer 18.564. Clear? Are able to understand? Next, calculation of NAV as on 30th June. How do I get NAV at the end of 30th June? Simple. I know the opening NAV. What is the opening NAV? 18.75 into 300. Okay. Portfolio value appreciation is given. What is the portfolio value appreciation? 425.47. Clear? The next, issue of a fresh units. Issue of a fresh units. 6 lakh units are issued at the rate of 19.2015. I receive 115.209. Income received for 3 months 22.95 plus 34.425 plus 45.45 102.825. Clear? minus units repurchased 3 lakhs into 18.564 minus income distributed 71.9019. So this will be the closing NAV divided by closing units. What are the closing units? 300 lakhs plus 6 lakhs minus 3 lakhs. So the answer is 20.267 is the closing NAV as on 30th June. Clear? Are you able to understand this? Done. Dividend equalization question. Next question is Sharpe ratio, Trainers ratio, and Jensen's alpha. How do you get Sharpe ratio in portfolio management? We already discussed the Sharpe ratio, Trainers ratio, and Jensen's alpha. How do I get Sharpe ratio? RP minus RF. What is RF? 9. 19 minus 9, 10 divided by 2.5. Standard deviation 2.5. So answer is Sharpe ratio is equal to 4. In the same manner, we calculate for what? Other 4 mutual funds. Higher the Sharpe ratio, better it is. Higher the Sharpe ratio, better it is. Navina, are you able to understand the dividend equalization question? Clear? Navina? Okay. Trainers ratio. How do I get trainers ratio? RP minus RF divided by beta. How do I get beta? Correlation with the market is given. This is sigma SM. I have to find out what beta. Beta is equal to sigma SM into sigma S divided by sigma M. In first case, what is the sigma SM? 0.840 into sigma S 2.5, sigma M 1.2. What is the beta in first case, Navina? Beta in first case, sigma SM 0.840 into standard deviation of security 2.5 divided by standard deviation of market 1.2. What is the answer for beta? You will get beta 1.75 in first case. Okay. So trainers ratio is equal to return 19 minus risk-free rate 9 divided by beta 1.75. So 5.75 is the trainers ratio. Higher the trainers ratio, better it is. So that's why first rank goes to C. Clear? Jensen's alpha. How do we get Jensen's alpha? Actual return minus CAPM return. How do we get CAPM return? RF plus RM minus RF into beta. In first case, the CAPM return is 17.75. Actual return is 19. So Jensen's alpha is equal to 19 minus 17.75, 1.25. Higher the Jensen's alpha, better it is. So mutual fund E is having a higher Jensen's alpha. Clear? Done? Okay. So we are left with how many questions? 2 questions. So there are only 6 questions to be practiced. 6 questions. Okay. So let me take a break for 15 minutes, and after 15 minutes, I will discuss another 2 questions. Clear? Navina, thank you. See the next question. There are 2 mutual funds. This is a conceptual question. There are 2 mutual funds. D mutual fund, K mutual fund. S Navina. Each having a close-ended equity scheme. So equity schemes can be open-ended scheme or a close-ended scheme. Open-ended scheme means investor can join anytime, can exit anytime, like our online class. So close-ended scheme means what? So for a fixed period of time, investor has to stay. For example, 6 months close-ended scheme. So scheme is closed for 6 months. That means in 6 months, a new investor cannot come in and the existing investor cannot go out. So this is a close-ended scheme. NAV as on 31st December 2014 of a equity scheme of D mutual fund is 70.71, consisting of 99% equity and remaining cash balance. So 70.71 into 90%, 99%, 70.71 into 99%, you will get 70 rupees. So cash balance, that means 0.71 is the cash balance in NAV. And K mutual fund 62.5 consisting 96% equity, 60 rupees, and the balance 2.5 is the cash. Following is the other information: Sharpe ratio 2, trainers ratio 15, standard deviation 11.25. There is no change in portfolio during the next month, and the average annual cost is rupees 3 per unit for the scheme of both the mutual funds. If a share market goes down by 5% within a month, calculate expected NAV after a month for the schemes of both the mutual fund. For calculation, consider 12 months in a year and ignore number of days per particular month. So we have to find out on a per month basis. Okay. So there is no change in portfolio during the next month. That means no purchase, no sale. There is no change in portfolio during the next month. Average cost is rupees 3 per unit for the scheme of both the mutual funds. Simple question. First of all, the clue given is the market, share market goes down by 5% is the clue. First, we should find out the beta. So what is the Sharpe ratio? 2. What is the formula for Sharpe ratio? RP minus RF divided by sigma is equal to 2. So nothing but RP minus RF is equal to 2 into 11.25, that is 22.5 will be the RP minus RF. I know RP minus RF, I know the trainers ratio. So trainers ratio is equal to 15, that is equal to 22.5 divided by beta. Beta is equal to 22.5 divided by 15. You will get beta. How much will you get beta? 22.5 divided by 15. You will get beta 1.5. Understand the meaning of beta 1.5. What is the meaning of this beta 1.5? For every 1% change in market, D mutual fund equity changes by 1.5%. But here in the question, the clue is given market goes down by 5% means equity goes down by 7.5%. What is the equity value in the NAV? 70.71 into 99%. That means 70 rupees into 92.5%. Why 92.5%? Because equity reduces by 7.5%. So that's why. So the answer is 64.75. The new equity after a month will be 64.75. What about the cash balance? The cash balance is 70.71 into 1%. 0.71 is the cash. 0.71 is the cash, but average annual cost is 3 rupees per annum. But per month it will be 3 rupees divided by 12 months. 0.25. So 0.71 minus 0.25, you will get 0.46. 0.46 will be the cash balance. So overall NAV after a month is 64.75 plus 0.46, you will get 65.21. Clear? In the same manner, we have to find out for K mutual fund. Clear? Are you able to understand this question? Now, Super 6, this question is for practice, constant ratio plan. So this question already tested in examination. Generally, students may skip this question. Be careful. General psychology of the student is, so practice question number 1, 2, 3, 4, 5. They will practice the questions in serial number, and they will leave the questions which are given in at the end, or they might refer the questions which are given at the end. But generally in examination, the questions which are given at the end will be asked. So that's why I have categorized the questions into smart and super. Smart questions are for referral, and super question is for practice. So that's why initially, we came across the questions which are to be referred. Okay. See the question Super 6. Miss Sunidhi is working with MNC at Mumbai. Miss Sunidhi is working with an MNC at Mumbai. She is well versed with the portfolio management techniques. Wants to test one of the technique on an equity fund. She has constructed and compared the gains and losses from the technique with those from a passive buy and hold strategy. Okay. She is well versed with the portfolio management techniques and wants to test one of the techniques. She wants to test one of the technique on an equity fund. She constructed and compare. She wanted to compare the gains and losses from that particular technique with those from passive buy and hold strategy. Passive buy and hold strategy means just to buy the equity and hold it for a certain period of a time. Okay, so that is a passive buy hold and strategy. So that is not her technique. Her technique is different. She wanted to compare the gains and losses from her technique with the gains and losses of a passive buy and hold strategy. The fund consists of equity only. The fund consists of equities only, and the ending NAVs of the fund he constructed for the last 10 months are given below. The fund consists of equities only, and the ending NAVs of the fund he constructed for the last 10 months are given below. NAVs for the last 10 months are given. Okay. Now see the question, this paragraph, highlighted paragraph. Assume Sunidhi had invested a notional amount of rupees 2 lakhs equity, 2 lakhs equally in the equity fund, and a conservative portfolio of a fund of a bond, conservative portfolio of a bonds in the beginning of a December 2008. She has invested rupees 2 lakhs equally in equity and also bond. That means 1 lakh in equity, 1 lakh in bond. And the total portfolio was being rebalanced each time the NAV of the fund increased or decreased by 25%, plus 15%. So this is her technique. What is her technique? Investing 1 lakh in equity, investing 1 lakh in bond, and rebalancing each time the NAV of the fund increased or beyond by 15%. But suppose NAV is not changing, NAV remains the same. That means there is no rebalancing. So whenever the NAV falls beyond 15% or increases beyond 15%, then we do a rebalancing. Okay, so nothing but it is a constant ratio. So she follows the constant ratio, that means 50-50. So what is the ratio she is following? Equity 50% and bonds 50%. Okay, but so what happens? Bond value will remain same, but equity value may increase or decrease. For suppose next day, what happens? 1 lakh invested in bond, 1 lakh invested in equity. For suppose equity value increased to 1 lakh 1,000, rebalancing will not be done. Okay, rebalancing will not be done. Okay, but if equity increases beyond 15% or decreases beyond 15%, then we do a rebalance. Sir, what is this rebalance? Example, equity value increased to 1 lakh 50. From 1 lakh it increased to 1 lakh 50 means 50% increase. So that means it increased beyond 15%. Then what I will do is 1 lakh bond value plus equity 1 lakh 50, total 2 lakh 50. I will divide the 2 lakh 50 between equity and debt equally. So 2 lakh 50 divided by 2, 1 lakh 25. So bond 1 lakh 25, equity 1 lakh 25. Nothing but I will sell 25,000 rupees worth equity and buy 25,000 rupees worth bond. So this is her technique. You are required to determine the value of a portfolio. So we are required to determine the value of a portfolio for each level of a NAV following the constant ratio plan. We have to follow the constant ratio plan. Simple question. What is the amount invested? 1 lakh in conservative portfolio, that means bond. 1 lakh in aggressive portfolio. This question is for practice. You should know what are the columns to be taken. First, NAV, bond, investment in bond, investment in equity, total value of a constant ratio plan. What is the total value of a constant ratio plan? 2 lakhs. Revaluation action and number of units in equity. NAV is consisting of total equity. Okay. So 1 lakh is invested, yes or no? 1 lakh is invested. What is the NAV when the amount was invested? 1 lakh divided by 1 lakh divided by 40. How many units? 2,500. Okay, in the beginning, how many units are purchased? 2,500 units are purchased in equity. Okay, clear? Next, in January, what happened? In January, NAV decreased to 25. Okay, NAV decreased to what? 25. So that means what happens? The bond value will remain same because it is a conservative portfolio. What about the equity value? Equity value will decrease to 2,500 into 25, 62,500. What is the total? 1 lakh 62,500. Clear? Value of a conservative portfolio 1 lakh 62,500, 1 lakh 62,500. Okay, 1 lakh 62,500. Done. So now, what is the change in equity? From 40 decrease it to 25. From 40 decrease it to 25. So you should note down the calculation. Otherwise, afterwards you might feel confused. 40 minus 25 divided by 40. This is the percentage change in NAV. What is the percentage change in NAV? 15 divided by 40. 30. 37.5%, which is beyond 15%. That means rebalancing has to be done. Rebalancing means nothing but this 1,62,000 total value of a portfolio 1,62,500 is shared between equity and bond equally. Clear? So 1,62,500 divided by 2, 81,250 bond, 81,250 equity. Okay, that means again see the calculation for this 750. See the calculation for this 750. That means 1 lakh minus 81,250 rupees worth bonds we should sell. 1 lakh minus 81,250 rupees. That means what? 18,750 rupees worth bond should be sold and buy equity, because we should maintain the constant ratio 50-50. Clear? What is the NAV on that particular date? NAV on that particular date is 25. That means how many units are we going to get? How many units we have to buy? 18,750 divided by 25. 750 units. So now the number of units will increase to 3,250. Am I clear? If you see the difference between 62,500 and 81,250, you will get 18,750. Nothing but sell 18,750 worth the bond and buy 18,750 worth the equity. Next 36. Next what? 36. 36 means what is the percentage change? 25 minus 36 divided by 25. 44%. Again, NAV increased beyond 15%. So that means rebalancing has to be done. Before doing the rebalancing, let us find out the value of equity at NAV 36. Bond value will remain same 81,250. What about the equity value? 3250 into 3250. How do I get this? 3,250 into what? 36. Clear? 1 lakh 1,17,000. Total 1,98,250. This 1,98,250 divided between bond and equity equally. That means 99,125, 99,125. This time we have to sell equity and buy bond. Sell equity. What is the amount of equity to be sold? What is the amount of equity to be sold? What is the calculation for this? What is the calculation for this? 1,17,000 minus 99,125 divided by what? 36 is the NAV on that data. So 496.53 units sell. That means the closing units will be 3250 minus 496.53, 2753.47. This question is for practice. Mandatory you have to practice. Done? So this is how we have to do the rebalancing till the end. This is the process. Everybody are able to understand? Okay. This is the constant ratio plan. What is the value, total value of a constant ratio plan by the end? By the end, the constant ratio plan is 2,40,647.58. This is the total value of a portfolio. Clear? She wanted to compare the profit or a loss from her technique with what? From her technique with a passive buy and hold strategy. What is this passive buy and hold strategy? Passive buy and hold strategy means invest in equity and wait. Passive buy and hold, just hold. That means what is the second option? Passive buy and hold. That means 2 lakhs, investing total 2 lakhs in equity. Okay, and hold. So what is NAV at the beginning? 40, yeah, NAV 40. That means how many units she is going to get? 5,000 units, yes or no? Into what is NAV at the end? 52. So that means in passive buy and hold strategy, the total portfolio value will be 2,60,000. Okay, clear? But whereas her strategy, constant ratio plan, under constant ratio plan, so the revenue she is getting is 2,40,647.58. Am I clear? Done. So which is the best one? Passive buy and hold strategy is the best one. Clear? Naveen, is it clear? Are you able to understand how we are doing the rebalancing and all? Are you able to understand what is this rebalancing and all? Is it clear? Is it clear? If NAV decreases to 32, then bond value will remain same, yes or no? 99,125. What about the equity value? Equity value 2753.47 into 32. 2753.47 into 32. Mohan Krishna. So this is 88,111.04. The overall value is 1,87,236.04. Here the rebalancing is not done. Why the rebalancing is not done? Because from 36 NAV decrease it to 32. So decrease only 4. 4 divided by 36. What is the percentage change? 11%. 4 divided by 36. 11%. So which is not beyond 15%. So that's why rebalancing will not be done. Clear? But 38. Increase it to 38 means 6 increase. Percentage 6 divided by 32. 6 divided by 32. 18.75%, which is beyond 15%, rebalancing will be done. So 99,125 bond value will remain same. Equity value will be 2753.47 into 38. 2753.47 into 38. The overall value 2,03,756.86. This total value is divided between equity and bond equally. Clear? So this time what we have to sell? Equity. We have to sell equity and buy bond. So what is the equity amount to be sold? 1,04,631.86 minus 1,01,878.43 divided by what? 38. 1,04,631.86 minus 1,01,878.43 divided by 38. How many units? 72.46. The number of units will get reduced to 2681.01. Clear? Done. Again, NAV decreased from 38 to 37. Percentage change is less than 15%. So no rebalancing is required. Clear? So this is not that easy question. So you should know how the columns should be taken, and also you should understand. Okay? Clear? Is it clear? With this, we have completed what? Mutual funds topic. Navina, am I audible? Tell me any issue with constant ratio plan. If you want me to explain again, I will explain. Otherwise, I will wind up the class. So one thing I want you to do is you have to solve May 23 mutual funds question. May 23 bonus plan. May 23 CA final question. This question was tested in November 2020, I think. So November 2020 paper was tough. CA final SFM. Later on again in May 2023, the paper was tough. SFM. Later on, the subject name changed from SFM to AFM. Okay. So and the last attempt. So some students have felt it like a tough. Okay. But I don't think so. Okay, and I request you to solve a September 2025 CA final mutual fund question. September 2025. If you want the explanation, I have already explained in OG revision series, which is made for CMA final SFM. I don't think you require an explanation. Go through the solution, you will understand. But mandatory, you have to practice these two questions, May 2023 and September 2025. Clear? So tomorrow again our class will be at 7 a.m. Done. Thank you.